Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research Global Markets EMEA and International Securities. It's Friday 10th May 2024, and joining Derek to pose some questions on the financial market themes for the week ahead is Simon Mays, Head of UK, Ireland and Swiss Corporate Sales. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hi, Derek. Great to have you here in sunny London.
Indeed. Good to talk, Simon.
It's been a pretty quiet week, so still quite a bit of focus on dollar yen. Last week it was the top performing G10 currency. This week the yen has been the worst performing. So it seems that the impact of last week's possible intervention is fading, and that maybe the Ministry of Finance in Japan is fighting against the tide from a fundamental perspective. So is there a role to be played by the Bank of Japan in the FX issue and dollar yen?
Yeah, good question, Simon. And I think a good one in the context of what's happened this week. It has been quiet, but there's been a few developments in Japan that are definitely worth mentioning. As I've said before, and I've written on a number of occasions in the FX research, Japan's running a real policy rate of more than minus 200 basis points. So when you're buying your currency with the monetary policy stance of over minus 200 basis points, you're going to be fighting against the wind in that context. And while everybody would logically say the big determining factor of any changes in the short-term spread between the US and Japan is, of course, going to be from the Fed, it's not right to say that the BoJ is irrelevant in all this. I think people say the BoJ is irrelevant in all of this because they say that in the context that the BoJ won't be doing that much anyway. And I think that's where things could change going forward from here. And I think this week is perhaps a good example. Now, we had Governor Ueda meet Prime Minister Kishida on Tuesday. Now, those are regular meetings that take place. They're not formalized. There's no set structure to them. So it's very feasible that Kishida asked to see Governor Ueda. His comments immediately after that meeting were pretty benign and bland. We'll monitor FX in the context of inflation going forward. But then over the next couple of days, we had Ueda speaking in the Diet, both in the lower house and in the upper house. And then also, most importantly, Governor Ueda gave a speech which was titled The Virtuous Cycle Between Wages and Prices and BoJ Monetary Policy. So, pretty crucial in the context of the BoJ going forward. And the translated version of that speech is on the BoJ website. I have the link in today's FX Weekly as well. And I've read through that. And certainly our takeaway is that it's further evidence of further increases in the BoJ's confidence of this virtuous cycle strengthening to give them the confidence in terms of price stability going forward. So I think it certainly backs up our view of a July rate hike. I wouldn't entirely rule out June, given the comments this week were much more specific in terms of yen depreciation and that being bad. It does raise the potential for the BoJ moving earlier than we expect. I'd still say June is pretty small, especially given the fact that this meeting between Kishida and Ueda and that seems to have turned the rhetoric more hawkish. If that then resulted in a June hike, there would be kind of market expectations that, there's some political influence. So Ueda may fight back on that. But obviously it depends on the incoming data as well. But definitely that speech is worth reading. It clearly shows greater confidence. He spoke about pronounced labour shortages in Japan, and that small and medium-sized firms are having to raise wages, even if those companies are in relatively difficult circumstances. So I think it was pretty clear, and it certainly backs up a rate hike by them. And I think then just in general, looking at kind of BoJ policy rates in the forward market, 2-year forward, 3-year forward, looking at 3-month TONA futures to the end of 2028, you don't get any implied levels that are over 1%. I think the future in December 28 is at 90 basis points. The OAS in 3 years is at 70 basis points. So I just think the implied terminal rate over the medium term, over those periods, is too low. And we're going to get the BoJ becoming more hawkish. If we get that July rate hike, the markets will start to price in the potential for another hike by the end of the year, which I think is very feasible if we get the soft landing in the US. So then in those circumstances, the BoJ does play a role in at least removing the ultra loose policy in Japan, and that, in the context of dollar yen, can certainly help to kind of reinforce recovery when it comes, in terms of when the Fed start to cut and dollar yen can start to move lower. So important developments in that context this week.
And just flipping to different central bank, as we said earlier, pretty quiet week, but a lot of focus on the Bank of England this week. I guess a bit of a damp squib in regards to FX markets, but any update on our thoughts on rate cuts from the Bank of England? Are we still looking for June potentially for the first rate cut?
That's been our call, and certainly I think yesterday's communications were consistent with that. They were still, I guess, a little bit careful. The formal guidance in the statement wasn't changed to indicate something that could happen sooner. But obviously we have Dave Ramsden shift and vote for a cut. And, he's got good history in terms of being an indicator of a change in policy. So back in November 2021, himself and Michael Saunders voted for a hike. So there was a 7-2 vote, with 2 voting for a hike. And then the following month, the Bank of England voted to hike rates 25 basis points, the first rate hike. So, he has form. I know it's only one previous occasion, but it's the last cycle, it's the last turn. And he is deputy governor, so he does have some sway. My feeling is that Andrew Bailey would go if he felt he had the majority, and he doesn't. Obviously, there's 3 hawks there that aren't going to be voting for a cut anytime soon. In terms of Green, so we have Catherine Mann and Haskell and Green, who clearly won't be voting for a cut. So it's really the three kind of moderates, if you call them, Broadbent, Breeden, and the chief economist Hugh Pill. Mm-hmm. So you need to get 2 of those to come over with Andrew Bailey, and then you're in the position to cut rates. And I think that's very, very feasible from the perspective of June. Now, we did get stronger data today, of course, the GDP. The level of the strength does surprise us, but there are some one-offs, which I'll mention in a moment. But, our broader view on the dollar weakening into the end of this year is about the global economy improving, not booming, but improving from where we've been. And I think this is certainly evidence of that. There are some elements that suggest we shouldn't read too much into the GDP strength. Imports plunged. Imports down 2.3%, I think. So the net trade contributed between 0.4 and 0.5 of the total quarter-on-quarter 0.6 GDP increase. So it was very much about that. Other elements as well, hospitality helped in terms of the services strength, but the early Easter this year, captured in Q1, could well have played a role in that. So we'll probably give back in Q2. So, and then there was less strikes in the health sector, which helped to boot the health area. So all in all, let's not assume a 0.6 quarter on quarter reflects the true health of the UK economy, but nonetheless, it certainly indicates an improvement. But to go back to the Bank of England in the context of June being a month for a rate cut, given what I've just mentioned there, I don't think the Bank of England would read too much into this rebound. Of course, they've already revised up their forecast for GDP this year from 0.25 to 0.5. So they are expecting stronger growth than what they expected in February, but still kept the guidance that signals or hints that there's a potential for a rate cut in June. So, yeah, obviously the inflation data, most importantly, along with the wages would be important. But I think all in, there's enough there for that rate cut that we're expecting in June.
Thank you. And finally, I always like to ask about your FX trade recommendations in a weekly. Anything we should be looking out for this week?
We're, given what I've just mentioned, we have been running a long euro sterling trade view. And we're keeping that. Long Aussie, short NOK hasn't really worked out. Maybe just the timing on that not correct. Although it's pretty much close to where we put it on. We've just decided to cut that. And then just kind of sensing the early signs of some cracks in the US dollar strength and the higher for longer. We've also put on a long euro dollar trade view. So we think there's a potential to get back up to the 110 level. Obviously, next week is important in terms of the CPI print. We're not putting it on just on a punt on next week, but obviously it would help if the inflation data comes in. We would say even just being in line with consensus would be enough for some relief. To suggest that the spike in inflation in January, February, March isn't lasting longer than that, and we see signs of some deceleration. I just think, as we've been saying for some time, we're moving towards slower labour markets. We're seeing declining pace in wage growth. If inflation now is better behaved in the next couple of months, we still feasibly think there's an avenue to the first rate cut being in July. We still have 3 CPI reports, including next week's, before the July meeting. So, 3 inflation reports and 2 more labour market reports, which last week's report was a little bit weaker than expected. It's all to play for in terms of July. So I think there's still plenty of scope for a reversal of that move higher in rates that we've had recently.
Thank you very much, Derek. Have a great weekend.
And you. Thanks, Simon.
Thank you for listening to this MUFG Global Markets FX Week Ahead podcast. Rate, review, and subscribe. Contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.